Good morning and welcome to the webinar on South Dakota unemployment insurance. I'm Katie Sieverding, Government Relations Coordinator for the South Dakota Retailers Association. Before we begin, I have a little bit of information about our association. The South Dakota Retailers Association is a 4,000 member statewide organization. Our primary mission is to represent retailers in the legislative and regulatory process. In addition, we provide information, offer training for food service and alcohol licensees, and provide member services. Those include credit card processing, business insurance, and data security. We also have an agreement with a labor law firm that allows our members to get answers to employment law questions from an attorney. Today's webinar is going to feature a presentation by Marcia Hultman, the Secretary of the South Dakota Department of Labor and Regulation. She has been a part of the DLR team since June of '97, first serving as Public Information Officer, then Workforce Services Director in 2000, and as a joint role as Director and Deputy Secretary starting in 2006. Secretary Hultman chairs the Unemployment Insurance Advisory Council and serves on a number of boards, including Workers' Compensation Advisory Council, Workforce Development Council, and the DOL Retirement Board. I just have a few things before we start the presentation. Number one, the phones of all attendees are muted, so we won't be hearing any background noise. At the end of the presentation, we'll have a question and answer period. If you would like to ask a question, you can just go to the panel on the side of your screen at any time. You may need to click on the orange button or the orange arrow to maximize that panel. You can type your message and click on send. After the presentation, I will read the questions out loud and Secretary Hultman will provide the answers. So now I think I will be turning it over to Secretary Hultman.
Thank you, Katie, and good morning to those of you participating. I want to give my sincere thanks to the South Dakota Retailers Association in allowing me this opportunity to visit with you this morning about unemployment insurance and how our system works here in South Dakota. So a big shout out and thank you to Sean, Donna, and Katie and the rest of the staff for working closely with the labor to provide you with this important information. So today what I'm going to do is first just touch on the very basic components of our UI system and how it works, not in a lot of depth, but to give you that broad overview of the system and obviously to stand by for your questions at the end. So with that, I just want to talk about the philosophy and the foundation of the unemployment insurance program. It is meant to be a temporary benefit for those who have lost their jobs through no fault of their own, to help them meet their financial obligations while they're searching and obtaining new employment. It is a federally run program and comes with a lot of federal rules and regulations that govern how we run the program in our state. So it is funded through an employer federal tax, which is used to administer the program, and then there is a state tax that is used to finance benefit payments. It was interesting, I've heard a lot over the years from individuals who have maybe applied for unemployment insurance benefits after losing a job and maybe were not found to be eligible for some reason or another, and they would frequently comment that I have paid into this system for years and now I'm not eligible to collect my benefits. So they're somewhat surprised sometimes as individual employees to learn that they've not paid into their system, that it is a tax that the employer pays and not the individual worker. So with that, the FUTA tax is what goes to the feds, and a percentage of that comes back to the state for the administration of the unemployment insurance system, as well as some of the workforce programs that the Department of Labor and Regulation delivers. South Dakota gets roughly 75 cents back for every dollar that employers pay in the federal tax, and that really varies widely from state to state. Some states get as little as 42 cents on the dollar back, so our rate of 75 cents has us faring fairly well. So that's a little bit about the taxes. On the benefit side, in South Dakota, an individual, if they're eligible for benefits, can receive up to 26 weeks of benefits. And each UI claim is very case and fact specific. So the maximum they can receive is 26 weeks, but for a different variety of reasons, they may not qualify for all of those weeks in entirety. The weekly benefits are 1/26 of the highest quarter earnings and up to 50% of the state average weekly wage. So currently for this calendar year in South Dakota, our minimum is $28, and that's been the minimum for years. Very few individuals, if anybody, would ever receive that minimum. But the max that an individual can receive in a week is $390. And again, that's all contingent on the wages that they have earned leading up to the layoff. So that whole eligibility component, it's important to remember that to be eligible for receipt of unemployment insurance benefits, that an individual has to have lost their job again through no fault of their own, and they have to be available for work. So if I don't meet those two criteria right off the bat, I'm not going to be able to receive unemployment insurance benefits. And then I also have to have earned sufficient wages prior to being laid off to qualify. To give you an example of how some of that works out mathematically, in order to be eligible for the maximum weekly benefit, you would have had to have earned $17,940 previous to the layoff. And to be eligible for both the maximum amount of $390 for the maximum number of weeks, 26 weeks, an individual would have had to have earned at least $30,000 prior to the layoff in the base wage period. So it gets a little bit confusing on how benefits are calculated, but it is all contingent on the wage history of the individual. And then as far as the employer that's responsible for the taxes, it depends on if you had multiple employers in the wage, I'm getting myself all confused on that, in the base period, then it could be multiple employers' accounts that are charged when the UI benefits are paid. And I'm guessing there might be questions on that as we get to the end. So that's just a really high-level, quick overview of the number of weeks that an individual can collect and the maximum amount of the benefit, and just briefly touching on how those benefits are calculated based on the wages. To give you an idea of how we compare, South Dakota is in the norm, so most states, as you can see from this map, do allow an individual to collect up to 26 weeks of benefits in a benefit year. A few states, you can see in the darker blue, allow for more than 26 weeks. And then there's also a handful of states that have fewer than 26 weeks set in state statute for how long an individual can collect benefits. And then occasionally, like during the recession, there may be federal extended benefits. At the federal level, they'll say that we're going to pay out of the federal account benefits for individuals past 26 weeks, but we've not been in a state or a status of having extended benefits for some time. So currently, the most weeks an individual can collect is 426. Each state has its own unemployment fund with the Treasury Department. So throughout this presentation, I'm going to talk a lot about the UI Trust Fund, or just simplify that to Trust Fund. And when I'm talking about that, I am talking specifically about the South Dakota dollars that are held in trust by the U.S. Treasury. And the U.S. Treasury is the trustee of all the funds for all the states. They invest all the receipts credited and maintain the invested assets until the money is needed to fund UI activity and the payment of UI benefits. The state account consists of the contributions and reimbursements collected and interest earned on those amounts. It is very clearly stated in law that our trust fund can only be used for the payment of individual benefits. And as we talk about the dollar amounts and talk about the balance in the trust fund, that's really important to remember. Sometimes individuals, the legislative body may look at the trust fund and see that there's $100 million in it and question whether or not that money can be used for any other purpose. And law is very specific that it cannot be. So with such a clearly defined role for the dollars, it removes any temptation for those funds to be directed to purposes other than they are intended for. So keep in mind that those dollars are all housed in the U.S. Treasury, and when employers are making payments to us, those must be deposited immediately into that federal account. As an employer, sometimes there's some confusion over how employer tax rates are figured, and employers are assigned tax rates based on their individual experience with unemployment, which is called an experience rating. Federal law does require that an employer must have at least 3 years of experience before receiving a rate based on experience. So a brand new business just starting out or a new employer will not have their own individual experience rating, so their tax rate is based on the industry that they're on or functioning within. And so based on that industry classification, their UI tax rate will be set for the first 3 years. Once they have established their experienced rating, then it will be their own unique rate that they have based on their experience. There was a question that came in prior to this webinar about the admin fee that is new this year and who pays the admin fee and who doesn't pay the admin fee. New employers do not pay the admin fee until they have their experience rating. And that's to keep things a bit more level and equitable, since often as a new employer, your tax rate may be a little bit higher those first 3 years until you've established your experience rating. And once it's established after those 3 years, then that's when you begin to pay the admin fee. There's also a situation we allow in South Dakota for employers, once they have that experience rating, to have a 0 rate. And if you have a 0% rate, once you have your experience rating, you also do not pay that admin fee. As you can see from the slide, that we do tax the first $15,000 of an employee's wages, and the contributions rates range from 0% to 9.45%. And those are the ranges for those experience ratings that I've been discussing. So again, each employer, it's case specific and fact specific and based on their utilization of the fund and their experience rating once they've established that after 3 years. So again, that was just a very high level, trying to keep a very complex system slightly simplified. But just to summarize that it is a system that's entirely employer funded. The maximum weekly benefit amount in South Dakota is $390 currently, and that changes on July 1st of every year, typically goes up every year. The trust fund use is restricted to simply the payment of benefits, and employer tax rates are based on individual experience after those first 3 years. Prior to that, it's based on the industry that they're in and the classification for that industry. There's a whole nother side to the system that I'm not going to go into in great detail today, and it is on how to file a claim, how to determine eligibility, and the whole process for a claimant. And I'm focusing more on the employer side today and not going into that. But we have multiple ways that an individual, once they have been laid off or lost their job, they can file for their unemployment insurance benefits over the internet. They can do it by phone. And the process then walks them through establishing their eligibility and then what the requirements are for them while they're receiving those benefits as far as being certified each week. And that could be a whole nother presentation based on how that side of the system works. But for now, focusing on the employer side, I really wanted to spend some time talking about the trust fund because I think it is of such importance to the health and climate of our business operations in the state. And so now that I've gone over the basics very quickly, I want to talk about that trust fund in more depth. And we've really had a goal with the UI insurance system to assure that those who are eligible for benefits receive their benefits in a timely and efficient manner. So that's the employee side of the equation. We want to make sure that they have those dollars coming to them so they can maintain their obligations while they're looking for new employment. The other thing that we want to do with that trust fund is we always want to assure that we're maintaining the right balance in the fund. And now I'm going to focus my comments on the work that the Unemployment Insurance Advisory Council has done in the last few years to assure that we do have that healthy balance in the fund. And I will tell you that the reason for that, you can see some of the notes on the slide, but our goal is to make sure there's enough money in that fund to sufficiently cover the claims that we might have during a recession. But at the same time, for the employer's benefit, we want to maintain a balance that's not too high because those are employer tax dollars that are funding it. And if we are taking more funds than the trust fund needs, that's fewer dollars in an employer's pocket to run their business. The other reason that we're so concerned with maintaining that healthy balance is during a time of a recession, if the fund ever dips below a certain amount, then all employers in the state are required to pay a surcharge. And so what happens, and it has happened in recent history, is right in the middle of a recession when things are tough anyway on all fronts, all of a sudden the Unemployment Insurance Trust Fund is too low. And then when they're struggling maybe more than typically, every employer in the state has that employer surcharge tacked on. So one of our primary goals is to develop a system and establish a balance that keeps that from happening again in the future. And then our overall goal is we want to keep dollars in employers' pockets. We don't want money sitting in the trust fund that is in excess of what we may need. So considering all of those things, we started the conversation a couple of years ago to really look at the trust fund and figure out what is the right balance, how much is enough, what is too much. And I talked about that surcharge a little bit. The level at which it kicks in is anytime and this is all in statute, anytime the balance dips below $11 million, the surcharge kicks in. And it kicks in even for those who are zero rated. So the surcharge goes on for everyone, and it happens anytime that the trust fund balance drops to 11 million at the end of a quarter, and the rates change from 0.1% to 1.5% depending on the trust fund balance at the end of each quarter. So you could have that increase of 0.1% or 1.5% depending on how low it is. And then unfortunately, once that surcharge is triggered, it stays on for 4 quarters. The rate may increase each quarter, but it will never decrease. So once we have to add that tax on, it stays on for a while and it can never be lowered. So you can see why it's so important that we avoid that surcharge at all costs. And so by carefully monitoring and establishing a method to determine adequacy, we can make sure that taxes are kept at a level that is appropriate for employers. So in looking at all of this, the steps that we took to just really sort out what is a sufficient balance in the trust fund. The first step for anything impacting the UI system is for it to be reviewed by the UI Advisory Council. And the UI Advisory Council is a governor's council with membership appointed for terms specific by the governor's office. And they are tasked with monitoring the content, adequacy, and effectiveness of the UI system. So that just gets down to are our tax rates set appropriately? Are we paying benefits properly? And are we running things to the right manner? So then this council looks at all things related to that, and then they make recommendations for improvements to the governor, to the legislature, and to the department. And the members of this council represent employers, employees, and public services. And they're required, again, in statute to meet at least twice a year. So I will tell you that this is really where ideas related to unemployment insurance are vetted. And oftentimes that will result in legislation. It's been historically true that if a bill related to unemployment insurance is introduced in the legislature and it hasn't been heard for input by the council and public comment during council meetings, typically those bills don't fare very well if it hasn't first gone through the council for their consideration. And that just helps ideas that are related to this really complicated system to be fully vetted out before they go to the legislature so they can get all the information they need to make their well-informed decisions. So before I talk a little bit more about the council's work in relationship to the health of the trust fund, this slide simply shows the membership of the UI Advisory Council. And I share these names and where they're located with you. You're very fortunate as a member of the South Dakota Retailers Association that Sean Lyons is a representative on this council. So obviously, if you have questions or concerns or changes or tweaks that you would like to see made to the UI system, you could certainly work with Sean to move your ideas forward to the council level. If you know any of the other individuals on the list in your local communities, you could also reach out to them. So again, the representation is made up on both the business side and the employee side, so we have fair representation on the council to make sure that we're giving full considerations to both sides of the issues. So for the purposes of the trust fund and the conversation that we've been having in the last few years, how much is enough in the trust fund and how much is too much, this group of individuals carefully looked at those issues and the system that we currently have. Now, hopefully this is all going to make a little more sense when I show you this chart, which really looks at the UI Trust Fund for the last few years. So if you look at this, the first column is the total income in. So for example, in 2007, that 26.3 is $26.3 million of taxes that employers paid in. The next column is the benefits paid out. So in 2007 calendar year, the division paid out $20.8 million in benefits, and leaving a balance at the end of the year in the trust fund of $24.7 million. And I will tell you, I've been with the department for about 20 years, and there's this conversation about how much money in the trust fund is too much has gone on for the entire time that I've been with the department. Prior to 2007, around 2000, a little bit in the 1990s, our trust fund balance would hover around $52 million. And at the time, it was thought, there were often conversations that that was way too much money to have in the trust fund, that we should be lowering the taxes on employers and allowing them to keep more of their dollars in their pocket, that the trust fund balance was just unrealistic and too high. Well, unfortunately, we saw in 2009, and those numbers prior to 2009 had been lowered as well, but we had the situation happen that we want to avoid at all costs. you can see that the income in 2009 was $31.6 million, but the benefits paid out when we were experiencing the recession were $63.6 million, leaving us not only below that $11 million threshold, but in the negative. And so what happened during that time period is we had to borrow money from the federal government, and we had to really reevaluate our entire structure and how we were collecting taxes. And there are a lot of things that happened that are reflected in this chart during the time periods represented that weren't just the results of the recession. We were also doing some legislative reforms going back as far as 2006. Prior to 2006, our wage base was $7,000, and remember today it's $15,000. It had stayed at that level for a number of years, but at the same time, our benefit payments, remember, are adjusted each year on July 1st. So you had this built-in disparity where benefits were going up each year, but the taxable wage base was not. So in 2006, there was legislation passed to increase the wage base each year until 2010, and it went to $8,500 up to $10,000 in 2010. And the maximum contribution rate was also increased at that time from 7% to 8.5%. And for the first time, negative employer accounts were charged interest on their negative account balances starting in 2009. So all of those things impact the total income in. And we've tried to adjust that and be reflective of that over the years. And then again, in 2011, there were additional changes to that taxable base wage, and it increased in 11 to 11,000 until it maxed out at 15,000 in 2015. And now there's nothing that will increase that currently in law. So that taxable base wage is set at 15,000 now. But again, the maximum contribution rate increased from 8.5% to 9.5%. So all of those things were done and adjusted so that we would have a trust fund balance that was healthy. And I just want to point a couple of numbers out on this slide that illustrate some of the points that I've made previously. You can see if you look from 2009 to 2010 that the total income into the trust fund was $84.2 million. And that was made up of different things, the loans that we received from the federal government, but it was also made up of the increase in taxes to employers to make sure that we had that level sufficient to cover benefits. And if you think about just coming out of the recession, we had that increase in taxes at a very hard time. And so that's the very situation that the council was trying to avoid when we looked at how to move forward in the future with what our balances will be. So fortunately, you can see from looking at this chart that our total income in became fairly stabilized, and that our benefit amounts, as our economy has improved and stabilized, our benefit amounts returned to normal levels consistent with non-recessionary years. So with those things happening, we began to see the trust fund getting to a level in 2016 of $112 million. And slightly prior to that, then we began to have the conversation, okay, the trust fund appears to be healthier now. We have money in the account. Let's look at everything that we've done in recent years and ensure that we're not growing the account to be too big. And so that was the reason for the conversations that we began to have. How do we stabilize the account? Remember how much is enough and how much is too much, and look at different ways to do that. I'm going to spare you all the details of the different mathematical methodologies that were looked at to establish that balance, because it's not just as easy as looking at it and going, oh, it's over $100 million, that's a lot of money, and so that must be sufficient. we finally settled on, after considering 3 different methodologies accepted at the federal level, on one called the Average High Cost Multiplier, or the AHCM for short. And what that does simply is it compares benefit payments during an average recession to the trust fund balance, and then it adjusts the dollars to current levels. So the methodology, we looked at 3 different ones, but the one that we settled on was the AHCM, and there were a lot of different reasons that we settled on this methodology, but one reason was that it's used strongly by the feds. And in fact, the feds now recommend that for states to be minimally solvent, that they have an AHCM of 1. And that means that they have enough reserves in their trust fund to pay 1 year of benefits during a recession. And that's during an average recession on December 31st of any given year. And so what we do is we look back at the past 3 recessions or the past 20 years, whichever is longer, to determine what level of benefits we would need to be able to pay. The states now require, we were eligible for no interest loans when we needed to support our trust fund when we hit that negative balance shown on the previous slide. And now in the future, if we would ever need to have a federal loan again, we would be required to have at least an AHCM of 1. So that also factored into our decision. The methodology, 1, was recognized by the federal government, and 2, the methodology is required by the federal government to be eligible for an interest-free loan in the future. So those were 2 reasons that the council decided that the mathematical methodology that we would use is the AHCM, and we looked at the minimum requirement of being 1. In the end, though, the council, after a lot of consideration, decided that they were concerned with that minimal word, that we wanted to have a standard a little bit higher than that in South Dakota. So rather than setting our level at an AHCM of 1, the council decided on recommending an AHCM of 1.6. And what that means is we're using that exact same methodology as the feds, but looking at a 1.6, it gives us enough money in our account to pay benefits for 18 months during a recession. So while the feds recommend a trust fund to be healthy at that point, or at the 1, the council's recommendation for a healthy trust fund in South Dakota would be a balance that showed a 1.6 AHCM, which correlates to a certain dollar amount on a date certain in a calendar year. So with that, what that all means, and I'm like, I feel like I'm leaving a huge part of this out. So it just basically gets down to how much is enough. And the council decided that when our AHCM in South Dakota was equal to 1.6, our trust fund was healthy and solvent. So then what happens for employers? Well, we wanted to be able to give employers a tax break when that happened. We wanted to return those tax dollars to employers' pockets. So we do all this work and we establish what is a healthy trust fund balance. And then last year we went to the legislature and said, okay, given all that, we can document that the trust fund is healthy. Now we want to have for years that we meet that 1.6 requirement. We want to put money back in employers' pockets and we're going to give them a tax rate. So to oversimplify, what happened is we now have 2 different tax tables. We have a tax table that's in place if the AHCM is above 1.6, and we have one if it's below 1.6. So each year, the Unemployment Insurance Division will evaluate the trust fund, and that's done in the spring, and they look at the balance in the trust fund, and then know that that coming year, what tax rate table will be in place. So for instance, we are currently at that healthy balance. We had an AHCM of 1.6, so when employer tax rate notices were sent out in October, they reflected the lower tax rates. Now employers have that lower tax rate for the entire calendar year. Our prediction is that we will again be at that healthy rate in the trust fund, so that tax table will stay in place for the coming year. So what we do is on June 30th, we figure out what your tax rate is going to be for the coming year, and then in October, you receive your notice for that next year, and you then know what your taxes are going to be starting January 1st. The only thing different now is when we have, again, that AHCM of 1.6 or higher, you're going to get that lower rate. And if we have in the trust fund, if the balance goes below that 1.6 AHCM, then the normal tax table will go back into place. So we didn't put in tax rates that increase taxes for employers. We only put in tax tables that reduced it or kept it at the current levels. So this chart reinforces kind of what I was just talking about, that we look at those benefit payments during the recession, and then on June 30th, if it's that 1.6 or above, employers get the reduced tax rate table for the upcoming tax year. And if the balance is below, then the regular tax rate table will be used for the upcoming year. And I know the council and myself felt really good about our success in getting this legislation passed last year, because it really is a way for us to be responsive and say and recognize, okay, we've got a healthy balance. We don't want to see that trust fund to continue to grow and grow and grow and grow beyond the level that is deemed to be enough. So now I'm just going to touch on some historic numbers for a second. So in 2017, and this is just to show how projections work and how accurate they can be. So this is what we projected that our benefits paid and projected would be for 2017. And at the end of 2017, we predicted that we would have $120.6 million in the trust fund, and that was enough for us to be at that AHCM of 1.6, which would give employers that tax break. As it turned out, we were a little bit higher at the end. Whoops. There we go. At the end, we were a little bit higher at the end of 2017 than we predicted. We actually ended up at 121.4, but you can see that we were very close. And again, that's what allowed that reduced tax table to be put into place. So now for 2018, we're looking at this, and you can see these are all projected. We don't have any actual numbers yet because we're still in that first quarter, but we're projecting that the trust fund will still grow a little bit, but based on the increase in benefits, it's good to have it grow a little, but not too much. And again, we're projecting that we will be at that healthy AHCM. So again, for the next calendar year, that lower tax rate should stay in place. So I've really touched on some high-level stuff that we had hours and hours and hours of conversations on, and some of it is fairly complex. I'm going to leave this time now for some questions if you have questions, but just know that it was our goal that we really wanted to maintain a trust fund that had enough money that we'd be able to pay benefits to those employers that were qualified, while at the same time not collecting too much so employers could keep those dollars in their pockets. And we were really happy to be able to devise a system that allowed for that. Another thing that happened at the same time last year was we did introduce a small admin fee, and that admin fee was necessary for the maintenance of our unemployment insurance division. Our federal funding over the years has decreased, but costs and expenses have increased for the administration of the UI program at the state level. We have been very responsive to that. We actually have reduced staff over the years and have been very conscientious about living within our budgets. But to maintain the presence of the technology that's required to run a system and to keep things current and to maintain those lower staffing levels, it was necessary for us to have that admin fee. So we have state funding in addition to the federal funding that we receive on an annual basis. With that, there were a couple of questions that were sent in prior, and I think I've answered both of them throughout my comments. One was, how long can somebody draw unemployment? And it really is case specific, but the maximum length of time is 26 weeks. An individual may qualify for fewer weeks if they had fewer wages in that base period. And that maximum benefit, again, is $390 a week. Another question that I had prior to joining you today was about the admin fee and how did some companies have it and some not. And again, if you reflect back on my comments from earlier, that new employers do not have that admin fee until they're experience rated. So new employers wouldn't have it. And then if you are experience rated and are at that 0 rate, you also do not pay the admin fee. So with that, I would stand by, Donna or Katie, if there are any questions from individuals on the webinar this morning.
All right. Thank you so much, Secretary. So I have some questions that have come in. I'll ask them now, but just as a reminder, if you want to ask a question, go to the panel on the side of your screen. There's an orange arrow button that you may need to click, but then you can type it in the question portion and we'll see it and I will ask it out loud. So with that, my first question for you, Secretary, is if a former employee, and there's a couple on this, so I might kind of combine them together, but if a former employee files for unemployment and is awarded benefits that I, as the employer, don't think they should receive, what are my options? Is there a way for me to challenge that decision?
Yes, thank you. There definitely is. Both the employer and the individual have appeal rights. And so you can contact the Unemployment Insurance Division and talk to them about that. There's a formal process set in statute and in rule to do that. So it can start with an appeal to me as the secretary. And from there, if you're not satisfied from that, it can actually go on to circuit court. So there is an entire process for that, and an employer definitely has the right to challenge whether or not they think those benefits were some that they were eligible for.
Okay. So if an employee is fired, do they automatically receive benefits? I know you touched on this a little bit. So for an example, I have an employee, I'm an employer, I have an employee who's late all the time and the till comes up short frequently. If I let them go, if I fire them, will they receive unemployment benefits?
No, remember again, it's very case specific. And that key phrase is has lost their job through no fault of their own. I will tell you that as in all things employee related, documentation is really important. But if you can show that there was misconduct or that they were not following directives or violating company policy, definitely then they're not going to be eligible for those benefits because their behavior is the reason that they were let go.
Perfect. Yep, that was another question. So what kind of documentation just any sort of documentation that would show that the termination is at not no fault of their own. Is that correct?
Right. So it's important to do things like if you have an employee handbook and it talks about your policy for being late, that you can document that that information was given to the employee, that they were well aware of what your policies were, and that you were enforcing them consistently. If you can document that they were late 3 times and given notice and they were told if they were late again, all of those kinds of things. Even, just quick handwritten notes with dates on them to verify that you had those conversations with an employee are important.
Perfect. So switching gears a little bit, if I have a worker who quits to take another job and then is laid off from that job and gets unemployment, does my account be affected?
Your account could be affected because it's contingent on the wages in that base period. So again, it's going to be case specific and how much of their wages were earned at your business and how much were earned at but you could have your account charged in that situation.
Okay. What about a probationary period? So the question is, I've heard somewhere that a business should have every employee on probation when they start. And then if you terminate that employee during that probation period, then is it correct that the account wouldn't be affected?
Again, I don't think it's going to matter what you call it. It's all based on the wages. So if they've been with you a very short time, they probably don't have enough history and enough wages earned that your account is going to be charged. But you wouldn't, for instance, be able to put them on probation for 6 months and say that none of those wages counted.
Okay. So then there isn't necessarily a specific length of time that the probation should last either?
I think to make sure, Katie, I'm going to follow up with Pauline, but I don't think it matters if you call it a probation period or not. I think it's based on the wages that they earned within that quarter.
Okay.
Regardless of how you've titled it. But for your members' sake, I'm going to follow up and I'll provide your association with clarification on that, and you can maybe send something out in writing or in addition to the notes.
Yes, that would be great. Thank you so much. Could you explain how much time a person has to work to be eligible for UI benefits? I think you'll touch on this in the answer, but the follow-up part of that question is part-time or a temporary employee, would they be eligible?
Yes, they could be eligible based on the wages that they earned in that base period. So again, it doesn't necessarily go back to how many hours they worked, but if I looked at a base period in their high quarter, they would have had to have earned $728, but that would just qualify them for that $28 minimum. So if you had somebody that was very part-time, if their wages still met that threshold, they could be eligible for benefits if they lose their job through no fault of their own. Okay.
And this one, it's kind of the same thing. So, and if an employee, or how can an employee go back on a prior employer if they don't qualify with their current employer where they lost their job or they were fired through no fault of their own on with their current employer, but they don't necessarily or they wouldn't qualify with them? Could they go back to a prior employee or employer?
No.
No. Okay. That was an easy answer.
Yeah. Sometimes it's best. Just.
Yeah. Okay. I think that's about all we have. I guess there's one more here. I have an ex-employee using benefits, UI benefits. How does that, or does that increase our rate the next time? I would assume that means the next quarter.
It wouldn't be for the next quarter. It may for the next calendar year if those benefits are enough to impact your experience rating and how much you have paid into your account. So it's all that, the ratio and the experience rating combined, your reserve ratio. So it may or may not, depending on what those factors are.
Oh, okay, perfect. All right. I think that's all the questions that I have had come in. With those questions, can you think of anything else we need to, or you would like to touch on before we sign off?
No, but I will tell you, I should have put my email address and Pauline's email address, because either one of us, Pauline better than I actually, could answer those really specific questions. And our email addresses, like all state email addresses, are simply our name with a period between them, and then @state.sd.us.
Okay, so marcia.hultman@state.sd.us.
Perfect.
And then,
yep.
Okay, and the same for
And
Pauline. So
correct.
Perfect. So if anyone has any questions, they can get a hold of you either with the phone numbers that are on the slide or by email.
Correct.
Is that fair? All
yeah,
right.
That is fair.
Oh, and looks like Donna posted them to the chat portion for all of our audience to see. So you should have both of those emails as well. All right. I don't see that any other questions have come in, so I think that will end our program for today. I thank you again, Secretary, for your presentation. I think it was a really, really informative one. And just a quick few notes before we get offline here. This webinar was recorded, so all attendees will receive a recording. It'll be emailed out to you later today, so you can go back and listen to any or all of the recording at your leisure. I would also like to let you know about 2 more opportunities that we have coming up, educational opportunities. On April 11th, we will once again partner with DLR to present a webinar on apprenticeships. And then in May, May 8th through the 10th are the dates. Our association will sponsor labor law conferences in Aberdeen, Mitchell, and Rapid City. So the 8th is Aberdeen, the 9th is Mitchell, and 10th we will be in Rapid City. At those workshops, employment law attorney Chris Hoyme of the Jackson Lewis Law Firm will focus on key issues facing employers today. And then we will also have the Attorney General's office over our lunch hour explain our new data breach laws that were just passed during this legislative session and how it will affect businesses of all sizes throughout the state. So you can check out our website, www.sdra.org, for more details. And the website also does include links to the webinar recording. So if some reason you don't get the email or you lose the email, you can also check out our website. So thank you again for everyone for participating in today's program.